Average monthly rise is the largest seen at this time of year since March 2004. Good afternoon, welcome to the Market Wrap, 1st of April 2022. Thank you for joining us. Stuart Williamson here at the helm. This is from Dubai, where I'm visiting some of our fantastic clients, meeting some lovely new people, and just experiencing what a great location it is to work. We've got our office here. If you'd like to speak to us in Dubai, please do get in touch, because that's what we're here to do. In general, if you're not in Dubai and you'd like to chat, I realised last week someone left a message saying, do we help people find property? Obviously, I'm not doing a very good job, because that's what we do. We help people find property all over the world, but specifically in Europe at the moment. Why do we do this? To keep people informed, have a bit of a laugh, and just tell people what's going on in the marketplace. So please do like and subscribe if you can. Press the remind me button, or whatever it's called, so next week you'll be reminded when something comes up. What are we doing this week? We're talking about three things. Short term, what is Rightmove telling us is going on in the UK market? Medium term, what is the Office of Budget Responsibility, which is an oxymoron in its own, budget responsibility and the UK government, I don't know. And finally, what is the view by BlackRock on the bigger global picture for everyone and the effect on the UK market on the back of that? Okay, so what happened in the UK market in the review that Rightmove put out for March? They saw another new price record as average prices of properties coming to market jumped by 1.7% to £354,500, breaking the 350,000 barrier for the first time. Extraordinary. Average monthly rise is the largest seen at this time of year since March 2004, pushing the annual rate of increase to 10.4%, with all regions, countries or counties except London and Scotland now growing at more than 10% annually. Most expensive sector was 4-bedroom houses, went up by 3.8%, £23,000 up. Monthly price surges are encouraging sellers to come to market, with 12% more new listings in this sector than any other since this time last year. For those looking to move, this is the best time ever, the best spring sellers market we've had, not just because of record price levels, because the mismatch that we've discussed previously between supply and demand. It's the biggest mismatch ever recorded by Rightmove, twice as many buyers as sellers. The chance of finding a buyer in the first week of spring is the highest it's ever been, and twice as likely in the same period to 2019. It's too early, according to Rightmove, to know how the market will be affected by longer term economic impact of the terrible devastation going on in the Ukraine. Rightmove initially saw a slight dip in demand at the beginning of the fighting a month ago, but this has now stabilised. They do forecast a less frothy market in the second half of the year as economic headwinds lead to a more evenly balanced market, though they expect demand still to outstrip supply. Okay, quite extraordinary, bearing in mind what we talked about last week and the week before on negativity. Tim Bannister, Rightmove's Director of Property Data, comments, there is a hat-trick of reasons for home owners to follow the normal trend and make it their goal to sell this spring. Firstly, the potential to achieve a record price for their property. Secondly, the imbalance between high buyer demand compared to low available property supply is the greatest that Rightmove have ever seen at the start of a spring market, meaning that the chance to be able to pick and choose between several suitable buyers is very strong. Thirdly, the proportion of properties finding a buyer within the first week of going on the market is an all-time high for this time of year. So it's bizarre, really. You know, if you're in the UK, it'd make you almost want to sell your house just to get the best price possible. And I think people are doing that. If you look at the diagram here, you can see that in the southwest and Wales lead the way with 14.5 and 14.4 year-on-year growth. For the first time, the northwest is not leading the way. with the East Midlands as the northern winner, West Midlands following behind that, and Scotland, going up by 8%. So what does it tell us? As I said, despite the doom and gloom of what we've had over the last 2 or 3 market wraps, interest rate rises, affordability issues, the market is still rising strongly. And we've gone on to say, as economic headwinds lead to more evenly balanced market, demand will still outstrip supply. And I think we've got a problem here. It's not the wealthy people that are suffering, it's the people with entry level. You try getting a mortgage for less than £100,000, it's virtually impossible. So that's a short-term view. What about medium term? As I said, the oxymoron, Office of Budget Responsibility, published its outlook alongside the spring statement. It's not called that budget anymore. The spring statement on Thursday. And their view was, I think, just as interesting what the other Chancellor said. Firstly, the OBR predicts that real household disposable incomes will fall by 2.2% in 2022-2023, which is the largest fall since official figures began in 1956. The majority of that fall is going to be driven by inflation, which the OBR thinks will peak at close to 9% in the fourth quarter of this year. And that will be the highest level of consumer price inflation for 40 years, when the second oil shock pushed inflation to double digits in the late 70s and early 80s. The OBR's outlook is underpinned by expectations in the financial markets that further interest rate rises will take the Bank of England's base rate to a peak, a peak of 1.9% by the end of next year. Now that's a peak of 1.9%. I remember when interest rates were way higher than that, and people were still buying in those days. Now we've got people flapping about 1.9%. It will be high, but it's not going to be that great. It's going to be the highest it's been since, I think, 2007, and since 2007, house prices have gone up by 74%. The view that the OBR has on the housing market, they expect demand in the housing market to ease over the next year due to the fall in real incomes and a rise in interest rates, causing house price inflation to slow to around 1% by late 2023. If you look on the chart below, you'll see that. Further out, expects swelling incomes to push annual house price growth to 2% by 2025 and 4% by 2027. So in 5 years from now, it's back on the roller coaster again. We've had a bit of a sit in the sidings for a while. It's back up again. It expects transactions to return to around 1.4 million a year, a level consistent with longer term average rates of housing market turnover. So back to normal. They're saying that growth in residential construction will slow to 2.6% this year from 12.6% in 2021 due to, again, logistical bottlenecks, which is what happened at the beginning of Brexit/COVID, which will weigh heavily on construction in the near term, which will again lead to more of a housing shortage. The GfK's measure of consumer confidence has also slid back to levels not seen since late 2020, as respondents cited spiralling inflation, high interest rates and the war in Ukraine as areas of concern. However, according to the OBR, house market sentiment on both current and future house-price growth remains resilient. But if you look at the chart below, the readings for both ticked up in March, but it's unlikely to continue, according to the OBR, over the next few months. It'll probably slow down towards the year end. So we're still seeing a lot of froth, a lot of excitement in the UK market, in the middle and the upper ends, not in the bottom. It's people at the bottom who are suffering. Finally, let's look at long-term view. It's a fantastic quote. The Russian invasion of Ukraine has put an end to the globalization we've experienced over the last 3 decades. That is a quote from the CEO, chairman of BlackRock, Larry Fink. And he put that in his influential annual letter that he sends to all shareholders, which was published just last week. Oaktree Capital, and their founder, Howard Marks, expressed similar sentiment in his FT column yesterday. Basically, he said, Companies have spent decades moving production offshore, bringing down costs via cheaper labour, boosting economic growth in those emerging economies, increasing savings and competitiveness for manufacturers, for global companies and importers, while providing low-priced goods for consumers. The reversal of this model, which is likely to happen now, will come with costs, particularly in the form of significant inflation over the shorter term. Now, if you can get a copy of Mr. Fink's letter, it's well worth reading. It's effectively a State of the Union for capitalism, and his comments on net zero are worth listening to as well. He basically says Russia's invasion of Ukraine will inevitably slow progress over the short term as far as getting towards net zero, while further out it will accelerate the shift to clean energy as people try and get away from importing fossil fuels and making renewables more competitive. We've already seen that in Germany, where they brought forward £200 billion worth euros of spending on renewables since the Ukraine conflict started. They want to get away from being reliant on Nord Stream 1. They almost went for Nord Stream 2. A lot of countries are going to look at that now. Globalization, which was everyone trusting each other, sadly has probably ended on the back of what's happened here. So there we go. Short term, things are going very frothy. We're not looking at a crash, and both Rightmove and the OBR say that. We're in for some headwinds, as they all love to say, and Mr. Fink at BlackRock agrees with that. So be wise when you buy, but at the same time, don't wait for the right time to buy and wait. So there we go. Please be in touch. Do take care, and don't forget to like and subscribe. Bye-bye.